Picture this. It's a quiet morning in Nanaimo, and two RCMP officers show up with CRA investigators at your door. They say they have a warrant to search your home, and they get inside your home. That's how the Colin McCartie tax case began, and years later, the Tax Court of Canada had to decide which parts of CRA's evidence could even be used. Hi, I'm Aman from Cloudivers CPAs in Burnaby, where we help businesses stay compliant and protected through smarter corporate tax planning and accurate filings. Let's unpack this case in simple terms. Mr. McCartie ran a small business and reported modest income for several years. CRA reviewed his returns and found that his spending, home purchases, and deposits did not match what was reported on paper. They said some expenses were personal, not business, and claimed that income had been understated. Reassessment followed with gross negligence penalties, which can be as high as 50% of the understated tax. At that point, CRA could have used what's known as the net worth method, where they compare your assets, debts, and personal spending to estimate underreported income. Instead, CRA went further. They brought in the Criminal Investigations Division, obtained a search warrant, and entered the home with the RCMP to seize tax and business records. That single decision changed everything because CRA lost key audit notes and did not clearly separate their audit work from the criminal side. The courts later ruled that some of the evidence was gathered improperly. When the tax court reviewed the civil tax appeal, it concluded that CRA could not rely on evidence obtained through that search or through the second audit connected to it. In tax terms, that's massive. It meant CRA could not use those documents to prove unreported income, apply gross negligence penalties, or reassess older years that were otherwise closed. The usual assumption that CRA's figures are correct did not apply, putting both sides on equal footing. For business owners, the message is clear. CRA builds its case from what your corporate tax filings show and the supporting evidence behind them. If those filings are inconsistent or incomplete, CRA fills in the blanks with estimates, assumptions, and, in extreme cases, deeper investigations. To avoid that, your corporate records should make your story obvious. Here's how you can protect your business. Ensure your T2 corporate tax return matches your actual results. Every number in your return, sales, shareholder loans, retained earnings, should trace back to financial statements that are properly reconciled. Avoid unexplained shareholder withdrawals. CRA often treats large draws as unreported income, and if not clearly recorded as dividends or loan repayments, this can cause trouble. And be cautious with personal expenses through the company. If CRA finds personal spending inside business accounts, they can deny deductions and add tax plus penalties. Always file GST, HST, and payroll remittances on time. CRA links compliance patterns, late filings, or gaps increase audit risk. Keep working papers for at least 6 years. CRA expects to see your adjusting journal entries, expense breakdowns, and schedules that support the tax return. These are small habits, but they build credibility. And in cases like McCartie's, credibility is everything. Had the original audit trail been stronger, CRA would not have needed to rely on search warrants to piece the story together. At Cloudivers CPAs, we help corporations stay on the right side of these lines. We prepare accurate T2 corporate tax filings, ensure your book to tax adjustments are documented, and design year-end tax files that stand up under audit. And when CRA raises a query, we handle the response package, reconciliation support, documents, and clear explanations so your position is defensible from the start. Think of Cloudiverse CPAs in Burnaby as your Google Maps. For your corporate tax route, we plan ahead, flag red zones, and guide you safely to the finish line with no surprises. The McCartie case is a reminder that strong corporate tax compliance is more than filing on time. It's also about traceability, documentation, and consistent financial evidence. When those pieces align, CRA reviews stay factual and short, not emotional and long. I'm Aman from Cloudiverse CPAs, and our focus is helping business owners manage corporate tax risk with confidence through clean filings, early planning, and ongoing advisory support. Thanks for watching, and I'll see you in my next video. Until then, bye.